Hi everyone, welcome to the webinar and workshop series conducted by TCS in lieu of the upcoming SCS exams happening in November 2025. My name is Nicholas and I'm the lead tutor and evaluator for SCS at TCS. So let's look at the session plan. First things first, I'm going to take you through your F3 syllabus, and once I'm done with it, I'm going to conduct a masterclass, thereby focusing your attention towards a question to do with financing options, which is a heavily tested area concerning your F3 syllabus. And then I will also explain a 3-week study plan to you. If you are yet to start your preparations, don't worry, you still have time. So if you stick to this 3-week study plan, you can make sure that you attempt all 6 mock exams and you have enough time to conduct revision focused on the same 6 mock exams. And as usual, I will be conducting a Q&A towards the very end of today's session. So let me remind you of the upcoming workshops we have scheduled for you. Just like what I'm going to do in today's session, I'm going to take you through your P3 and E3 syllabi, and at the same time, I'm going to conduct a masterclass focused on one of the syllabus areas taken from P3 and E3 syllabi in the upcoming workshops. And in the final workshop, which happens just 2 or 3 days before your examination, I'm going to share last minute tips with you to make sure that you walk into the exam with a high level of confidence, a high level of positivity, because as per the CIMA examiner, if you believe in yourself, you can easily pass this examination. So make use of these free resources on offer, just like what we have done in the previous weeks. I hope you will attend the upcoming workshops as well to gain a lot of knowledge about how to tackle each syllabus area, and at the same time to improve your positivity. And let me quickly take you through your F3 syllabus. So I'm going to direct your attention towards our mock exam syllabus coverage document. And when developing the mock exams, we have made sure to cover all these syllabus areas. So in today's session, I want to singularly direct your attention towards your F3 syllabus or your finance strategy syllabus. So in this syllabus, your knowledge concerning financing options with regards to debt versus equity will be tested. So you need to have a good understanding of how to approach questions to do with financing options. If you're evaluating about debt funding, there are certain elements which you need to consider. And at the same time, when thinking in terms of equity, there are various different options. And you need to know how to structure answers when opting for equity funding. And that is why I'm going to direct your attention towards a question to do with financing options in today's session. And also, when opting for debt, you have to demonstrate creditworthiness to lenders, especially if you're lending from an international bank or in a country in which you are operating for the first time, because definitely, given the size and the way in which we conduct our business in an international sense, Cewmlator already enjoys good relationships with its existing lenders. But let's assume that we are moving into a totally new country. When this is the case, it could be us, trying to sell our vehicles in a totally new country, or it could be us setting up a factory, or acquiring some type of a supplier which is based on a totally new country. If when doing so, we have to get in touch with the local lenders. And when opting for debt financing, you have to think in terms of how we should prove our creditworthiness to these lenders and what type of issues we might face when trying to borrow money from these lenders with whom we have not dealt with previously. And also, you should know how to handle a rights issue, especially if we are opting for equity funding. Then the easiest way to raise money is to opt for a rights issue. And when doing so, there are various different elements or angles which we need to cover to make sure that our rights are taken up. Because if our rights are undersubscribed, it's not too good for our share price. It's not too good for our reputation. So we have to look at various different angles when opting for a rights issue. Also, in terms of opting for debt, once more, we have to think in terms of the existing debt covenants of the company. I'm going to talk about these things or debt covenants in today's session. So, in a nutshell, when opting for additional debt, we have to think think in terms of the existing contracts which we have signed or covenants which we have signed with our existing lenders or existing banks. And when opting for some type of an acquisition, when acquiring a new company, we might take a decision to, when we acquire a company, such a company will definitely have debt, and this debt should be considered as ours in a post-acquisition scenario. So when doing so, when driving these type of acquisitions, we have to be considerate about the existing debt covenants. And because if we breach these debt covenants, it won't be too good for us in terms of opting for long-term funding. So even when our gearing is below 50%, we have to think in terms of the existing debt covenants, and we should not take loans which will breach these debt covenants. And also, you should know how to value companies, especially when opting for acquisitions. It could be with regards to acquiring a public limited company, such as us, a quoted company, or most probably it's going to be with regards to acquiring an unquoted company. So when opting for any of these type of acquisitions, your knowledge concerning company valuations, because as you know, there are various different valuation methods which will be tested at your exam. So you should know the pros and cons of each valuation method and which valuation method is the most suitable concerning the company which we are trying to acquire. And also your knowledge concerning dividends will be tested. So you should know, what we need to think, or how should we approach dividend payments, because there's a way in which you should structure your answers. You need to think in terms of because of these dividend payments, how we are going to be financially impacted, and at the same time, because of these dividend payments, how various different shareholders which operate with various or varying objectives will be impacted, and at the same time, how these dividend payments will impact our reputation as well as internal dynamics. So all these things will be tested. And similarly, you should know how to tackle with a situation in which the company decides to cancel a dividend. When doing so, there is a foolproof method which we need to adopt to make sure that our reputation is not harmed, to make sure that our stakeholder or shareholder relationships are not impacted negatively, and at the same time to make sure that our share price will not drop unduly. So all these things will be tested. And your knowledge concerning integrated reporting, especially given the fact that Cewmlator believes in sustainability. So when a company believes in sustainability, they should not only think in terms of its financial performance, they should also direct their attention towards ensuring non-financial performance. So your knowledge concerning the 6 capitals framework will be tested. And also you should have the capability of evaluating how various different risks will impact our share price, how the beta value increasing or decreasing impacts our share price. You should know, you should have a good understanding of the connection between the beta value and the share price. And on top of that, you should know, what our existing beta value tells about our company and how it can be impacted when we are exposed to some type of risk, or some type when we are trying to exploit some type of opportunities. So whenever the company tries to exploit some type of an opportunity, how it impacts our beta, how it impacts our share price, all these things will be tested at your examination. So when developing our 6 mock exams, we have made sure to cover all these elements. And in today's session, as I mentioned earlier, I'm going to direct your attention towards a question to do with financing options, in which your knowledge concerning debt versus equity funding is tested. All right, so let's look at what this mock exam looks like. So I'm going to direct your attention towards section number 3, subtask A of mock exam 1. However, in order to gain a good understanding of the scenario, I'm going to read through the reference material which is relevant for section number 2, because there is an interlink between section 2 and 3. So in order to make sure that you gain an understanding of what this mock is all about, I'm going to read you through the reference material before I direct your attention towards the question concerning section 3. So Cewmlator's R&D team has completed successful tests of its roof integrated solar panel system. So in the first section, the board was contemplating about introducing a roof integrated solar panel system. And in here, our R&D team, in the second section, our R&D team has completed successful tests concerning our roof integrated solar panel set of vehicles. The tech allows for trickle charging during parking, extending the range for users in high sunlight regions without requiring grid access. Interest from other manufacturers has surged, and with Atom, which is our closest competitor, expressing intent to license the technology to enhance their ESG credentials. So we have, innovated something, and this innovation seems to drive competitive advantage. That is why our closest competitor has reached out to us, and therefore they are expressing intent to license this technology in order to improve their own ESG credentials. So this indicates the fact that we have found something which is innovative, and this is in high demand within this market. The board acknowledges the revenue opportunity, but is also mindful of intellectual property risks and the risk of losing competitive advantage. Yes, just because our closest competitor approached us, we should not blindly share this technology with them. Instead, we should always safeguard our intellectual property. To mitigate this, Cewmlator plans to use third-party escrow services to safeguard sensitive design and technology data, along with patent protections and non-disclosure agreements. So what's the intention of safeguarding our intellectual property? If we decide to share this technology, we have to safeguard our intellectual property. So what's the intention of achieving this? Cewmlator plans to use services offered by a third-party escrow service. And this escrow service, or this third-party specialist, is going to safeguard our sensitive design and technology data, and they are going to look after our patents and keep tabs about non-disclosure agreements, and keep checking whether, if we share this technology with Atom, whether Atom is going to take steps to safeguard our intellectual property. These measures aim to maintain control over intellectual property while enabling secure licensing, sustainable growth, and technological leadership. So this is the most effective way of sharing technology. We should not blindly share technology with a third party. Instead, we should make sure that we take steps to safeguard our intellectual property. So in order to practice this licensing agreement, we have found a third-party escrow services provider, which is going to safeguard our design elements, technology data, as well as look after our patents, and keep tabs about non-disclosure agreements, which we have signed with Atom. All right, so this is what's highlighted in the second section. So let's direct our attention towards section number 3. A month later, you receive the following email from the finance director. I have attached a scanned copy of a quotation that has been circulated to the board. So let's look at what appears within this quotation. So this is a quotation which we have received from vEscrow, and there are two different prices which you can see within this quotation. There's an initial escrow setup and integration cost which comes up to $600, and this is in C dollar terms, which indicates the fact that this company is probably located within a foreign country, and so that's the cost tied to initial escrow setup and integration. And there's an annual escrow management fee which comes up to $5 million in total. We are supposed to spend C dollars 605 million as per this quotation. And let's try to understand what these two cost elements are. Initial escrow setup and integration. We propose a customized escrow arrangement for Cewmlator's roof integrated solar panel technology for electric vehicles, securing technical documentation, design schematics, and software protocols to protect intellectual property. Access will be granted only to licensed parties under strict legal and technical conditions. So that is what this escrow arrangement is all about. And in order to secure our intellectual property, secure our design elements, this company is going to charge us $600 million. And with regards to this $5 million, vEscrow will maintain the escrow arrangement through ongoing services, including 24/7 system availability and tech support, quarterly compliance audits, secure updates and integration of design enhancements, controlled digital release of assets to licensees upon trigger conditions. So in order to maintain this escrow service without any hiccups, on an annual basis, this company is going to charge us $5 million. So the initial setup cost is $600 million in C dollar terms. And on an annual basis, we are supposed to pay $5 million C dollars with regards to maintenance of these escrow services. All right, so that's what the quotation is all about. So let's look at what your requirement is. vEscrow has an excellent reputation for the provision of escrow services. The company is based in Zealand, whose currency is the C dollar. So that's exactly why I said this company is located in a foreign country, which is Zealand. vEscrow insists on being paid in its home currency because it is stronger than the D dollar, our local currency. The exchange rate is presently $5 equal 1 C dollar. So we have to pay $5 from our end to purchase 1 C dollar, which indicates the fact that the C dollar or the Zealandian dollar is extremely strong compared to our home currency, which is the D dollar. I'm interested in your opinion on these matters. Recommend with reasons how we should finance the initial escrow setup and integration cost of $600 million C dollars and the annual escrow management fee of C dollars 5 million. So you have to look at both elements. You have to first things first think about how we should finance the initial setup cost, which comes up to $600 million, and then how we should finance the annual escrow management fee, which comes up to C dollars 5 million. So as you know, before you develop your answer plan or before you plan out or structure your answer, you are supposed to simplify the requirement in your own words in a concise manner. So that's exactly what you can see in here. So I've simplified the requirement, which goes as how to finance IS investment. So I've kept it simple so that I can gain a good understanding of what the requirement is. And at the same time, whilst developing the answer plan, if I want to check whether my answer is aligned with the requirement or whether I'm headed in the correct direction, I can easily refer back to a simplified requirement and see whether my answer is aligned with the requirement or not. So how to finance the IS investment, and the weightage provided is 50%. Based on that, 25 marks are dedicated for this subtask. So let's look at how you should structure your answer. So let me scroll down to the relevant area. So I've come up with a main heading which goes as funding options, which is in bold and underline format. And I've utilized subheadings as well. I've utilized a subheading which is in bold format, thereby directing the marker's attention towards how to deal with the escrow setup and integration cost. And again, I've utilized another subheading which directs the marker's attention towards my answer concerning how to deal with the annual escrow management fee. All right, so let's look at how this answer should be structured. So first things first, I'm going to look at this total investment in D dollar terms. So this total investment as per the quotation is 605 million C dollars. That's exactly what you can see here, 605 million C dollars. And we have to convert it into D dollars before we think in terms of how this is going to impact us financially. So I've converted this into D dollars, which comes up to a total of a staggering 3.25 billion D dollars. How did I arrive at this figure? As per the exchange rate, 1 C dollar equals 5 D dollars. So I've multiplied 605 million by 5, which comes up to 3.25 billion D dollars. So that's the total investment. Now let's direct our attention towards the escrow setup and integration cost, and then direct our attention later towards the annual escrow management fee. So looking at the escrow setup and integration, it comes up to C dollars 600 million. So in D dollar terms, 600 million into 5 comes up to D dollars 3 billion. And we have to find these $3 billion if we are to license this innovative technology whilst safeguarding our intellectual property. And when trying to find this money, this amount of money, we have two options at our disposal. The two options are to opt for a long-term loan, which is known as debt, or we can issue equity. So the two options are we can opt for debt or equity, or in other terms, we can opt for a long-term loan or opt for equity. So first, let's direct our attention towards loan financing. So if we are to raise this money, let's try to understand whether we are in a position to raise this amount of money by opting for a long-term loan. So whenever you are thinking in terms of opting for a long-term loan, you have to think in terms of how it is going to impact our gearing, because as you know, lenders, before lending us money, they will always check our gearing rate. If our gearing rate is below 50%, they would be totally fine. They won't charge us an additional interest rate. However, if our gearing is above 50%, we are seen as risky in the eyes of the lenders. And when lending to a risky business, lenders will charge an additional interest rate. And when they charge an additional interest rate, our finance costs will increase. When our finance costs increase, then our profits will decrease. So that is why you are supposed to think in terms of how additional debt will impact our current gearing. So the pre-investment gearing is 41%, as you know, because as per your pre-seen, as per what's highlighted within the financial analysis slides, which I've already shared with you, the gearing of the pre-investment gearing or the existing gearing of the company is 41%. And then you have to recalculate a post-investment gearing considering this investment. So you have to consider the fact that the company is going for this investment, which comes up to $3 billion in total. So include this additional debt and recalculate the gearing ratio. And when you recalculate the gearing ratio, you will arrive at 44.5%. So 44.5% indicates the fact that our gearing is supposed to increase. However, still gearing is below 50%, which indicates the fact that we can easily go for debt financing. And at the same time, since our post-investment gearing is well below 50, then we can easily go for additional debt in the future as and when necessary. And since our post-investment gearing is just 44.5% or below 50%, the lenders will not charge a higher interest rate from us. So we can borrow money at the normal interest rate. Therefore, we are in a position to benefit from this investment if we opt for debt funding. And also, when thinking in terms of debt funding, on top of gearing, always think about the interest cover as well, because this interest cover indicates whether we are generating enough operating profits which enables us to repay our finance costs or our loan interests on time. So our interest cover is 4:1, which indicates the fact that we can easily meet finance costs utilizing our operating profits. What does this interest cover indicate? This indicates the fact that we are generating 4 times the operating profit compared to our finance cost. So if our finance cost is just $1, then our operating profits, we are generating operating profits which come up to $4. So when we have $4 at our disposal, we can easily pay $1 as the loan interest or as our finance cost. So we are generating 4 times the operating profits compared to our interest finance costs or our loan interests, which indicates the fact that we can easily meet finance costs utilizing our operating profits. And therefore, when we will have enough money to repay interests on time, it will satisfy the lenders. And this ensures that we would have access to competitively priced debt finance in the future, or we can borrow at the normal interest rate. So whenever you are tackling a question to do with debt funding, always talk about gearing, always talk about the interest cover. Based on these evaluations, you can signal to the board as to whether we can easily go for debt funding or not. So that's your answer concerning loan financing. So let's look at the other option at our disposal. So I've spoken about long-term loans, and then when it comes to raising this amount of money, we can issue equity as well. So that's the second element which I'm going to talk about in this part of the answer. So we have already spoken about the impact of gearing and interest cover. And then you have to think in terms of whether we can secure this loan, which amounts to $3 billion. And when doing so, we have to think about what this investment is all about. So it appears that it might be difficult for us to secure this loan, which comes up to $3 billion. Why am I saying this? Because of the fact that we are raising this money to utilize services offered by escrow by an escrow services provider. So we are therefore investing on an intangible asset. And when we are investing on an intangible asset, and when we inform our lenders about the fact that we need the money to finance or invest on an intangible asset, the lenders are not going to be too happy. Why is this the case? Because intangible assets cannot be easily appraised. And at the same time, if we do not pay this loan, then the lenders will want some type of security. So when opting for some type of an investment tied to a tangible asset, such as property, plant, and equipment, we can keep this property, plant, and equipment as security when opting for a loan. So let's assume we are, putting up a building, and when building one of our factories, we are opting for loan financing. And when doing so, we are supposed to keep this factory as security, or the land as security. And if we do not pay the loan on time, the banks can come and claim the land or the factory which is half built. However, since we are dealing with an intangible asset, the banks cannot do so. The banks cannot liquidate an intangible asset easily. And on top of that, the value of an intangible asset cannot be appraised easily as well. Therefore, when we are trying to fund some type of an intangible asset, it is considered as bad collateral in the eyes of lenders. So the lenders are going to think twice about lending us money, especially given the fact that they cannot, hold on to this intangible asset as a good security, because they cannot. If we don't pay the loan on time, they cannot liquidate this asset easily, given the fact that it is an intangible asset. And on top of that, this $600 million, or in D dollar terms, $3 billion, include setup costs as well. So this is a one-time cost, and these setup costs will have no resale value. Again, because of that, because of this fact, these setup costs will be considered as bad collateral in the eyes of the lenders. So with regards to securing this loan, although our interest cover is all good, although the post-investment gearing is going to be good, with regards to securing this loan, we might face some type of problem, given the fact that we are trying to raise $3 billion to fund an investment on an intangible asset, and no financier wants to keep intangible assets as collateral. Therefore, the only other option at our disposal is to consider our existing property, plant, and equipment. So let's direct your attention. I want to direct your attention towards the financial statements of your company. So let's look at what appears within the statement of financial position of Cewmlator Group. So as you can see, our non-current liabilities come up to 20 billion in total. Our non-current liabilities or long-term loans come up to 20 billion in total. And if you add this $3 billion, which is tied to this investment, it is going to be $23 billion in total. And looking at the property, plant, and equipment figure, or the tangible assets of your company, the tangible assets come up to $27.5 billion. So you can clearly see, even after we add these $3 billion, our tangible assets or property, plant, and equipment figure is higher than our non-current liabilities or long-term borrowings. So since we are not too certain about whether the financiers or the banks are going to hold on to this intangible asset as a collateral, we can keep our existing property, plant, and equipment as collateral when opting for this loan, because there's some additional amount in here which comes up to, when you deduct 27.5 against $20, $20 billion, it comes up to an additional property, plant, and equipment figure of $7.5 billion. From this, if we deduct the $3 billion, still we have additional property, plant, and equipment or tangible assets at our disposal. So that's exactly what you can see in here. You have to compare between the current non-current liabilities of Cewmlator against the property, plant, and equipment or the tangible asset figure. And this indicates the fact that our property, plant, and equipment is higher than our non-current liabilities. Therefore, we can secure additional debt against our existing assets. So we need not worry too much about securing this loan. Just because it is an intangible asset, we can, keep one of our existing property, plant, and equipment or our tangible assets as collateral when opting for this additional debt. And also, when opting for additional debt, we have to think in terms of our existing debt covenants. So although our gearing is below 50%, we might have signed debt covenants with our financiers. And we have to think in terms of how these debt covenants are going to be impacted in a post-investment scenario, and always make sure that we are not breaching these debt covenants, because if we breach these debt covenants, our banks are going to sue us. And when this is the case, it is sending the wrong signal to our shareholders, and shareholders will panic and end up selling their shares. And when the share price drops, when we are experiencing a drop in investor confidence, it will impact our reputation, which in turn will impact the relationships we have with our other stakeholders in a negative manner. So given the fact that we are dealing with an intangible asset, we will find it a bit hard to secure this loan. However, we can utilize our existing tangible assets or property, plant, and equipment to secure this loan. But when doing so, we have to think in terms of the existing debt covenants and take steps not to breach these existing debt covenants. So that's how you should structure an answer concerning debt funding. So I've first things first spoken about gearing. Then I've spoken about the interest cover. Then I've considered whether we can secure this loan or not. And with this in mind, I've looked at the current property, plant, and equipment or tangible asset figure to gain an understanding of whether we can opt for this loan without any hiccups. All right. So having said that, let's look at how we should deal with equity financing. So as I mentioned earlier, rather than selling shares to the public, the easiest way to raise equity funding is to opt for a rights issue. So what is a rights issue? A rights issue is a situation where a company raises money by selling shares to its existing shareholders at a discount. So there are already investors who had invested or shareholders who had invested on our business. So we are selling shares to the same type of individuals, which is known as a rights issue, in which we are selling these rights at a discount. Why are we selling these rights at a discount? Because then it will motivate the existing investors of our company to take up these rights, which will ensure that we gather the required amount of money by opting for a rights issue. And when we opt for a rights issue, our equity figure will increase. When equity increases, you know for a fact that the gearing decreases. And when gearing decreases, it is good for us because then it gives us some additional space to opt for loan funding in the future as and when necessary. However, the success of a rights issue depends on how shareholders are convinced. So we have to make sure that the investors take up their rights. In order to ensure that they take up their rights, we have to do something to convince these existing shareholders of ours. So with the intention of convincing them, we have to talk about why we are opting for this type of money, for this type of an investment. And we have to clearly mention how beneficial this investment is going to be for the company's success in the future. So escrow services will significantly enhance the credibility of the licensing agreement, because if we share this new technology with our closest competitor as well as various different players within this industry, we are going to be benefited by additional revenue streams, because if we opt for these licensing agreements, each and every time a car manufacturer utilizes our technology, we are going to get a royalty payment. And these royalty payments are going to be significant, especially given the fact that this industry is an ever innovative industry. And we have to think in terms of the charging infrastructure, and we have found a solution to this major issue tied to charging infrastructure, because when we install capabilities within the car itself, which enables the car to charge its own battery, then we are addressing customers' needs concerning charging, a lack of charging infrastructure. So this is going to be extremely beneficial for us, extremely profitable for us. So with the intention of benefiting from these licensing agreements, and at the same time safeguarding our intellectual property, we have to invest on escrow services. So escrow services, if we utilize escrow services, this significantly enhances the credibility of the licensing agreement, and therefore we will be benefited from positive NPVs, and we'd benefit from long-term value. And therefore it is easy for us to convince the shareholders to take up these rights. And if they take up these rights, if we convince them properly, if we communicate with them properly, then we will end up generating $3 billion without having to get in touch with our banks or external financing. All right, so that's how we should tackle a question to do with financing options concerning debt and equity. And also, there is a mention about the annual escrow management fee, which comes up to $5 million. So I've come up with a separate set of points highlighting how we should fund this initiative. So this investment in C dollar terms is 5 million, or in D dollar terms, it is going to be $25 million. And remember, this is not a one-time payment. Instead, this is a recurring expense. So each year we have to pay this amount, which comes up to $25 million. And when funding a recurring expense, you have to think in terms of working capital. You should not opt for long-term financing options. Instead, you should think in terms of working capital. Always remember this demarcation. If we are going for some type of an investment concerning the long run of the business, then you should opt for long-term loans or equity or debt or equity funding. However, if we are trying to fund a recurring expense, an expense which we need to incur each year, then you are not supposed to go for long-term loans. You are not supposed to go for equity. Instead, you should think in terms of working capital. So since this is a recurring expense, I'm stating the fact that we should finance this 25 million investment via working capital. And when we go for short-term financing or short-term funding, or when we think in terms of utilizing our working capital, it won't impact our gearing. Why? Because when calculating the gearing ratio, you are supposed to only consider the non-current liabilities. You are not supposed to consider the current liabilities. So as you know, the gearing ratio, the formula is debt divided by debt plus equity. And under debt, you are only considering non-current liabilities. You are not supposed to consider current liabilities. So when considering about working capital, we are thinking in terms of current assets and current liabilities. We are not thinking in terms of non-current liabilities or non-current assets. So since we are expected to finance this investment via working capital, it is not going to impact our gearing. And also, when opting for working capital funding, you have to think about the net current assets of your chosen company. How can we determine the net current assets? It is current assets minus current liabilities. So you have to deduct current liabilities from your current assets. And when we do this, we arrive at $8.5 billion D dollars. So our annual escrow management fee is just going to be $25 million D dollars. When we have 8.5 billion, a positive $8.5 billion at our disposal, this indicates the fact that we can easily finance this annual recurring expense, which comes up to $25 million. And also, we can finance this investment via a short-term loan. And when opting for a short-term loan, again, it is not going to impact our gearing, and we can easily negotiate with our lenders by sharing cash flow forecasts tied to this investment. We have to show to our lenders about how much money we are going to raise on an annual basis via this licensing agreement. And on top of that, we have to, when negotiating with the lenders, we have to consider our interest cover, which is 4:1, which increases our negotiating power, because as I mentioned earlier, we are generating 4 times the operating profits compared to our finance costs, which indicate the fact that we can easily meet the financing needs, or we can easily repay loan interest or finance costs. And all these things should be considered when negotiating with the banks in terms of financing this recurring expense. So we can, finance it via our positive, net current asset balance, or on the other hand, we can simply opt for a short-term loan, given the fact that our net current assets is a staggering $8.5 billion. All right, so that's how you should structure your answer. So this is I've covered all elements, all angles concerning a question to do with debt and equity. So what you need to remember is, when we are going for long-term, when you're considering long-term funding, you should consider long-term loans or equity, or debt or equity. However, when you are thinking in terms of recurring expenses or annual expenses, you have to think in terms of utilizing our existing working capital, or opting for a short-term loan if we have a negative working capital balance, which is not the case when you look at your chosen company. And once you have developed this type of an answer plan, then as per our answering technique, you have to take steps to expand the answer plan in paragraph form. So your final answer should not look something like this. Instead, your final answer should be in paragraph form. That's exactly what you can see here. I've simply expanded each point which I've included within the answer plan in paragraph form. All right, so that's what I wanted to highlight concerning a question to do with debt and equity. All right, so also, if you're yet to start your preparations, you still have time, as I mentioned earlier. So I'm going to share this study plan with you after this session via the WhatsApp group. So if you stick to the study plan, you have the opportunity of attempting all 6 mock exams, and at the same time, you have enough time to conduct your revision. So as per this 3-week study plan, you should keep out the exam week, because you are not expected to attempt any mock exams or develop answer plans and whatnot within the exam week. The exam week is solely dedicated towards revision. So in the first 3 weeks, you should focus your attention towards attempting 2 mock exams per week. And as I mentioned earlier in the previous webinars, just because you attempt mock exams, you are not going to pass this exam. Instead, you have to spend some time to revise. So that's exactly what you can see in here. After attempting each mock exam, you have to watch the master classes. A while back, you experienced how we conduct our master classes. And the objective of conducting these master classes is to explain the logic behind each answer, and at the same time teach you the theoretical elements covered within each mock exam. You learned what debt and equity is all about and how to approach these elements. And also, we teach you application via these master classes. So if you are coming through an exemption route, or if you had failed previously, it's essential that you gain access to these master classes so that you gain a clear understanding of how to tackle each syllabus area and how to structure your answers. And once you have learned your theory and application, then you are supposed to conduct revision on your own, which is to redevelop answer plans on your own. This is when you are solidifying your knowledge, which you have gained via these master classes. So similarly, in each week, you are supposed to master 2 mock exams per week. And if you do so, in the exam week, you are simply supposed to refer to the 6 answer plans which you have access to. And when you go through these 6 answer plans, it's as if you are going through the entire syllabus one last time. And at the same time, you are reminding yourself about how to approach each conceptual element and how to structure your answers, how to work how to work out your application. and reread the annotated pre-scene and stop all work 2 days before the exam and start resting. Because as I mentioned in the fourth webinar, I explained stress management techniques with you. And when doing so, I highlighted the benefit of taking a break, 2 days, at least 2 days before your examination. So if your exam is on Wednesday, you have to stop all your work at least by Sunday night. Take a 2-day break, spend time with your loved ones, be involved with leisure activities, because I want you to be relaxed, calm, and composed before the exam. Because if you're calm before the exam, you will be calm and composed at your real examination as well. So if you're yet to start preparations, don't worry, you still have time. If you are disciplined enough to stick to this 3-week study plan, definitely you can increase your chances of passing in this sitting. All right, so having said that, before we move on to the Q&A, let me quickly tell you what we offer at TCS. So I'm on the SCS page. If you're yet to create a free user account, click on this button and create one. And once you have created a free user account, you would gain access to our student dashboard. And when you are in this student dashboard, click on My Courses. And in front of SCS Free, you would see an Access Content button. Click on it. And once you click on it, you'd gain access to the recorded versions of the weekly webinars and workshops. And under the study material tab, you'd gain access to the pre-scene mind map, as well as the answer plan of mock exam 1. And under the mocks tab, you'd gain access to the questions and suggested answers of mock exam 1. And under the exams tab, you have the opportunity of attempting mock number 1 under exam conditions via TCS's exam platform. And as you know, we have developed an exam platform which is the exact replica of the Pearson VUE system on which you attempt your real examination. So attempt mock number 1, which is the best way to practice your answering, time management, and stress management techniques. And if you're interested in investing on our paid content, click on this button and check the sample material before you do so. And if you're yet to join our SCS WhatsApp group, click on this button and join it. Via this group, we'll keep you guys informed of the weekly webinar and workshop commencement dates and times. And at the same time, if you have any questions, you can get them answered via this SCS WhatsApp group. And talking about what we offer 2 packages, the Essential course and the Premium course. The Essential course is designed for those who have completed their OTQs. So since you have completed your OTQs, you have already learned your theory. When attempting mocks, your focus should be to improve your application skills. So under the Essential course, you'd gain access to the recordings of all weekly webinars and workshops, 6 mock exams with suggested answers, and we have made sure to cover all syllabus areas via these 6 mocks. And this time, you're not only gaining access to 6 mocks. I've already developed 7 mock exams, and I've covered 63 subtasks within these 7 mock exams. And once you go through all these 63 subtasks, you'd gain a good understanding of how each syllabus area can be tested at the exam and how you should approach each syllabus area. And you'd also gain access to pre-scene analysis videos, 3 videos in total. And once you have watched these 3 videos, you will gain an in-depth understanding of the entire pre-scene document. You will also gain access to the annotated pre-scene, the industry and financial analysis slides. Let me quickly show you what these resources look like. So this is the annotated pre-scene which we have developed. So we have come up with annotations with the intention of summarizing the entire pre-scene. Also, we have highlighted probable exam scenarios which can be tested, and the syllabus areas which can be tested based on these probable exam scenarios. So when developing your mock exams, we have made sure to cover all or each of these exam scenarios and syllabus areas. And similarly, we have conducted an evaluation concerning your industry. So in the first part of the industry analysis slides, we have defined your industry. In the second part, we have explained about the competitive landscape. In the third part, we have highlighted industry trends, and based on these industry trends, scenarios will be thrown at you at your real exam. And towards the very end, considering 2 real-life companies, we have explained how these companies operate within your typical industry. And also, we have evaluated your financial statements. We have made sure to keep things simple so that you can easily gain an understanding of the financial situation of your company. So we have evaluated the SOPL, the SOFP, and the statement of changes in equity. And also, we have, most importantly, conducted a ratio analysis. So in today's masterclass, I directed your attention towards the gearing and interest cover. Both were covered within today's mock exam. So likewise, I've covered all angles, and when conducting this ratio analysis, I've made sure to compare your company's performance against its closest competitor so that you gain a good understanding of the financial situation of your company. So these are the resources on offer under the essential course. You'd also gain access to the top 20 likely issue slides, which indicate the most probable scenarios which can be tested at the exam. You will also gain access to a case study familiarization kit. Once you have gone through this kit, within 10 to 15 minutes, you will gain an in-depth understanding of the technicalities behind your exam. You also have access to a tutor-managed live chat and OTQ revision cards. So after attempting each mock exam, if you feel that you cannot remember a certain conceptual element or you don't have a good understanding, simply refer to these revision cards to brush up your knowledge in a jiffy. So the essential course is priced at £299. And talking about the premium course, this course is intended for those who are coming through the exemption routes and those who had failed the exam previously. So both these sets of students have the same problem. There are gaps in theory knowledge and issues with application. So with the intention of teaching you theory and teaching you application skills, we have included some additional resources under the premium course on top of what appears under the essential course. So under premium, you'd also gain access to the online mock exam platform on which you can attempt all 6 mocks under exam conditions, which is the best way to master your answering, time management, and stress management techniques. You gain access to answer plans of all mock exams. You saw what an answer plan looks like and how beneficial it is, because when you have access to these answer plans, you can easily figure out the logic behind each answer, and it will assist you with revision, because our revision is focused on redeveloping answer plans. So when you redevelop answer plans, you are supposed to compare your fresh answer plans to TCSs to further improve your understanding. So you have access to answer plans, and also you gain access to 15 masterclasses in total. And you saw how we conduct our masterclasses in today's session. And in each masterclass, whilst taking you through the logic of each answer, we are teaching you the relevant conceptual element covered within each mock exam, and also highlighting how to work on application. And you also gain feedback on 2 mock exams, namely mocks 3 and 5. And this is the type of feedback on offer at TCS. You can see how extensive feedback was provided to this student. So you will benefit from this type of feedback as well. And it's essential that you gain access to this type of feedback, especially if you're coming through exemptions, especially if you failed previously, because it's good to understand what your shortcomings are, because if you do not understand your shortcomings, you cannot take steps to overcome them when conducting your revision. And at the very end, we have indicated mark allocations on a subtask by subtask basis. Not just mark allocations, we have also indicated the success rate as well. And by looking at the subtasks which are highlighted in yellow, you can easily spot the substandard the subtasks in which your performance was substandard. And then when conducting your revision, your job is to redevelop answer plans focused on the subtasks which are highlighted in yellow. All right, so that's the type of feedback on offer under premium. And therefore, the premium course is priced at £849, which can be paid in 2 installments of £424 each. Or if you opt to pay in full, you will get a £100 discount, and the price is going to be just £749. So you can invest on your preferred course by clicking on either of these buttons. And all products are available until the 28th of February 2026. So if you're planning on sitting for the SCS exams happening in February, you can start your preparations right now, which gives you some additional time, which is going to be beneficial in terms of revision. And let me quickly take you to the SCS study plan as well, because some of you are sticking to our original 8-week study plan. And let me explain what you are supposed to achieve within this week. So we are in week number 5 as per our original 8-week study plan. And within this week, you are supposed to master mock number 4. So first things first, attempt mock 4 under exam conditions via our exam platform. with the objective of practicing your answering time management and stress management techniques. And you need not worry about learning anything through this process. The objective of attempting mocks under exam conditions is to simply practice your answering time management and stress management techniques under exam conditions. And once you have practiced these three techniques, then you should focus your attention towards learning theory and improving application. That is why you have to watch the 3 master classes. Once you have learned theory and application, then revise by redeveloping answer plans. Once you have redeveloped your answer plans, compare your fresh answer plans to TCSs to further improve your understanding. So within this week, you are supposed to master mock number 4. That is if you are sticking to the original 8-week study plan. If you are planning to stick to our 3-week study plan, within this week, you are supposed to master mocks 1 and 2. All right. So we are happy to say that we achieved a 91% pass rate in the previous sitting, which happened in August. And the individual who scored the highest amount of marks for SCS ended up scoring 121 marks. And this individual, Luca, was able to complete CIMA in its entirety, 3 papers, OCS, MCS, and SCS within just 1 year, and passed each sitting in the first instance itself simply by sticking to our study plan. So you can achieve a similar feat if you stick to our study plans, which we have shared with you already. So having said that, I'm moving to the Q&A. So I'm going to pause the recording. All right, folks, thank you very much for those questions. I hope I addressed everything. So if you want to contact us, you can do it via our website, which is www.study@tcs.com. Visit our website and click on the contact button and drop us a message. Our admin staff will get in touch with you via email during office hours. And you can email us at info@study@tcs.com. If you need instantaneous support, drop us a message via this WhatsApp number. And I urge you guys to follow us on our social media handles, especially YouTube and TikTok, because the recorded versions of these weekly webinars and workshops are uploaded onto our YouTube handle. And via TikTok, you'd gain access to 6 videos, which is a good pre-seen mind map. So on your way to office, for instance, on a daily basis, keep watching these 6 TikTok videos to constantly keep yourself reminded of the most important points highlighted within your pre-seen. And similarly, we have already shared this pre-seen mind map, which is in PDF form with you. So go through this document as and when necessary to remind yourself of what appears within your pre-seen document. So having said that, it also, if you're yet to read our blog post, click on this button and read the blog post, which is based on Cewmlator. So having said that, it brings us to the end of the masterclass conducted in lieu of the upcoming SCS exams. I hope you gained something out of this session. And if you are yet to start preparations, don't worry, you still have time. So if you are sticking to our original 8-week study plan, keep pushing, keep fighting. And if you are planning to start prep, you still have time. It's simply a matter of attempting 2 mock exams per week. And if you do so, if you commit yourself, you can easily pass this examination. So I hope to see you guys next week at the next masterclass, in which I'm going to take you through your P3 syllabus and at the same time take you through a question concerning your P3 syllabus, just like what I covered in today's session. So thank you for joining. I'll see you guys next Saturday.